The purpose of this presentation is to provide an overview of the traditional home valuation methodologies that are utilized in order to analyze residential real estate property, to provide an overview of two valuable analytical methodologies that prospective home buyers need to be using in order to assist them in making a prudent home purchase decision, to provide an overview of the issues that prospective home buyers should consider when analyzing residential real estate, and to explain why prospective home buyers need to use the Adkins Residential Home Valuation Analyzer. This presentation was produced by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our company has an exclusive focus on residential real estate. Our company is not affiliated with any parties that are associated with the residential housing industry. Therefore, the information and analytical tools that we provide are objective in content and application and void of any conflicts of interest. Our company's mission is to bridge the gap in the residential housing market, where deficiencies in public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and effective analytical tools that will facilitate their decision-making process. We have incorporated our knowledge, experience, and wisdom into our residential real estate analysis software application and our residential real estate research. Therefore, we truly believe that prospective homebuyers can use our information and analytical tools in order to make a prudent home purchase decision. In order to help prospective homebuyers make a prudent home purchase decision, I have developed an internet-based residential real estate analysis software application that is marketed in the industry as the Adkins Residential Home Valuation Analyzer. Our software application utilizes proprietary finance-based and expense-based analytical methodologies. Our analytical methodologies allow prospective homebuyers to determine the level of underpricing or overpricing of homes in their community, as well as accurately assess the costs associated with owning a home. Our goal is to offer a comprehensive, accurate, automated, user-friendly, and affordable residential real estate analysis software application in conjunction with providing contemporary information about the trends and events that are taking place in the residential housing market. We strive to accomplish these goals in an economical, efficient, and effective manner by using a direct-to-consumer business model. Our commitment to you is that we will continuously strive to make Adkins Capital Management, the ARVA Residential Real Estate Analysis software application, and our residential real estate research the premier analytical source for prospective homebuyers to use in order to make a prudent home purchase decision. Now that I have provided an overview of Adkins Capital Management, let me turn your attention to the first traditional methodology that is used to analyze residential real estate, which is known as the cost-based method. The cost-based method is a fundamental valuation process that relies on the premise that the price of a home should be a function of what it costs to produce the home. The cost-based method is primarily used by home builders. It is a process that is easy to understand, and it may serve as a helpful valuation technique for analyzing new home purchase opportunities and existing home purchase opportunities during normal housing markets. Unfortunately, there are many problems that are associated with relying on the cost-based method. To begin, the cost-based method is difficult for most prospective homebuyers to utilize. Due to the complexity of compiling a complete list of building materials and their associated costs, such as the foundation materials, to the roofing materials, and everything in between. Moreover, it is very difficult to accurately determine the cost for land acquisition and labor utilization. This in turn makes the application of the cost-based method very difficult to apply. The application of the cost-based method becomes even more complicated when one has to take into account the cost impact of an abnormal inflationary or deflationary environment, or when the value of an older home has been significantly impacted by dilapidation or obsolescence. With these issues in mind, it is easy to conceptualize why the cost-based methodology is a very complex process to apply. Finally, and perhaps most importantly, the cost-based method has a significant shortcoming because it does not take into account the impact of the ongoing operating expenses that are associated with owning a home, and it does not take into account the cost of debt financing, which is a significant expense for most homeowners. Given these omissions, the cost-based methodology is critically flawed in terms of helping prospective homebuyers make a prudent home purchase decision. The sales-based methodology is the second traditional method that is typically used for conducting residential real estate analysis. The sales-based method relies on the premise that the price of a home should be correlated with the price of recently sold homes that have comparable characteristics. The sales-based method is a very popular methodology that is utilized by the news media, academic professors, home builders, mortgage lenders, real estate agents, and prospective home buyers. Moreover, the sales-based method is easy to understand, very easy to apply, and may be a helpful valuation approach for new home purchase opportunities and existing home purchase opportunities during normal housing markets. As a result, the sales-based method is the primary analytical tool that people use to analyze residential real estate property. Unfortunately, there are many problems associated with utilizing the sales-based method to analyze residential real estate property. To begin, in many cases, the sales-based method relies on data that is untimely, inaccurate, and incomplete. This problem is confounded given the fact that it is almost impossible to verify the quality of the sales-based data that is provided by third-party organizations. With this in mind, the use of sales-based data should always be properly scrutinized by cross-referencing the data with information that can be obtained from a governmental entity, such as the Property Valuation Office. Unfortunately, few prospective home buyers perform this type of due diligence. As a result, many people are likely using misleading data in order to make their home purchase decision. Another problem with using a sales-based method is that it is very difficult to find a home with comparable characteristics for comparison. For example, differences in where a home is located, differences in the size of a home or the size of a home's yard, differences in a home's floor plan, its siding materials, or its roofing materials, as well as differences in the quality of a home's interior, make it very difficult to accurately apply the sales-based method. In addition, the differences between the needs of the individuals that recently purchased a home and the needs of a prospective home buyer may dramatically skew the accuracy of using sales-based data. For example, a home that recently sold in a neighborhood at a specific price may have commanded such a value because its location facilitates a short commute to work, or perhaps it is located in a favorable school district, or maybe it is located in close proximity to certain recreational amenities, such as a golf course or tennis center. However, if a prospective home buyer works many miles away from a home's location, or does not have children, or does not play golf or tennis, then these types of amenities may not merit a comparable premium in the price of a home. This in turn would make the use of sales-based data a very inaccurate valuation methodology. Finally, and perhaps most importantly, the sales-based method has a significant shortcoming because it does not take into account the impact of the ongoing operating expenses that are associated with owning a home. and it does not take into account the cost of debt financing, which is a significant expense for most homeowners. Given these omissions, the sales-based methodology is critically flawed in terms of its ability to help prospective homebuyers make a prudent home purchase decision. Now that I have provided an overview of the cost-based method and the sales-based method, let me turn your attention to the finance-based methodology, which is a methodology that was developed by Adkins Capital Management in order to help prospective homebuyers accurately assess the price level of homes in their community. The finance-based methodology analyzes the relationship between the median home price level for a city and the median household income level for a city in order to determine the level of underpricing or overpricing of homes in a city. The finance-based method takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the finance-based method can accurately assess the price level of homes in a city. From the first analytical perspective, the finance-based method determines the level of underpricing or overpricing of homes in a city by calculating the mortgage loan interest rate that justifies the price level of homes in the city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in the city. To illustrate how this first process is utilized, let us assume that the mortgage loan interest rate that justifies the price level of homes in a city is 6.5%. Let us also assume that the national average mortgage loan interest rate is 4.5%. With this information, homes in the city would be classified as underpriced because mortgage loan interest rates could increase by more than 2 percentage points before homes would be classified as overpriced in the city. Given this information, prospective homebuyers should reach the conclusion that it is appropriate to purchase a home in the city. From the second analytical perspective, the finance-based method calculates the percentage of household income that would have to be spent by the people that live in a city in order to justify the price level of homes in the city. With this information, the finance-based method compares the justified percentage of household income amount against a traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in the city. To illustrate how this second process is utilized, let us assume that the finance-based method determines that the percentage of household income that would have to be spent by the people that live in a city in order to justify the price level of homes in the city is 48%. With this information, homes in the city would be classified as overpriced because the percentage of pre-tax household income amount would have to decrease by more than 20 percentage points before the price level of residential real estate property would be classified as underpriced in the city. Given this information, prospective homebuyers should reach the conclusion that it is not appropriate to purchase a home in the city. It is important to note that the Adkins Residential Home Valuation Analyzer allows prospective homebuyers to tailor the finance-based analysis to take into account specific household income amounts, home price amounts, cost of debt amounts, and percentage of pre-tax household income amounts. By allowing prospective homebuyers to tailor their analysis to take into account these specific variables, prospective homebuyers can accurately assess the level of underpricing or overpricing of homes in their community. In order to provide a specific example of how the finance-based methodology can be used to analyze residential real estate property, a historical assessment of the U.S. housing trends from 1989 through 2013 can be utilized. For example, According to the U.S. Census Bureau, the median household income amount was $52,250 in 2013 and $30,056 in 1989. In comparison, the median home price level was $265,092 in 2013 and $120,383 in 1989. As you can see from the chart in the presentation, it appears that a significant problem in the residential housing market has developed over the past 25 years, as home price levels have increased at a much higher rate than household income. Indeed, this issue could be a significant problem because most prospective home buyers obtain a mortgage loan in order to purchase a home, and they repay their mortgage loan with their household income. Therefore, household income and home price levels typically need to move in lockstep in order to maintain a stable housing environment. With that said, the dramatic decrease in the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan from 10.32% in 1989 to 3.98% in 2013 brings to light some key points that prospective home buyers need to consider before purchasing a home. For example, when people look at the relationship between the median household income amount and the median home price level for 1989 versus 2013, they would likely be more concerned about the residential housing environment in 2013 due to the pronounced mismatch between the median household income level and the median home price level during that year. However, due to the much lower cost of debt in 2013, only 29% of household income would have to be spent by homeowners in order to justify the median home price level in that year. And this amount is only slightly above the traditionally accepted amount of 28%. Moreover, the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan would only have to trend down from 3.98% to 3.7% in order to justify the home price level. Therefore, while on the surface it appears that the mismatch between the median household income level and the median home price level was a material problem, based on the justified percentage of household income amount and the justified mortgage loan interest rate amount, the median home price level was only slightly overpriced for the nation in 2013. In comparison, in 1989, the median household income level and the median home price level appears to be more properly aligned. This in turn would likely lead people to believe that the price level of residential real estate property was stable in that year. However, given the high cost of debt for a 30-year fixed-rate mortgage loan, 44% of pre-tax household income would have to be spent by homeowners in order to justify the median home price level. This amount is significantly greater than the traditionally accepted amount of 28%. Moreover, the national average mortgage loan interest rate would have to decrease substantially from 10.32% to 5.75% in order to justify the median home price level. Therefore, while it appears that the relative alignment between the median household income level and the median home price level in 1989 was satisfactory in terms of maintaining a stable housing environment, based on the justified percentage of household income amount and the justified mortgage loan interest rate amount, the median home price level was significantly overpriced for the nation in 1989. Now that I have provided an overview of the finance-based methodology, let me provide 6 advantages that prospective home buyers need to consider. First, the finance-based methodology is based on the correct financial concept that the price level of any asset that is purchased with debt should be a function of the income level that will be used to repay the debt, the percentage of the income level that will be used to repay the debt, and the cost of debt. This concept is very important for prospective homebuyers to understand, because in many cases, they incorrectly believe that the price of a home is simply a function of what it costs to produce the home, or is a function of what a comparable home recently sold for in the community. Second, the finance-based methodology allows prospective homebuyers to conduct an analysis based on their specific risk profile, because it facilitates their ability to evaluate the justified household income amount against their personal view of how much money people in their community should be spending in order to repay the principal and interest costs of their mortgage loan. With this information, prospective homebuyers can precisely gauge the level of underpricing or overpricing of homes in their community. Third, the finance-based methodology allows prospective homebuyers to conduct a market risk analysis by facilitating their ability to evaluate the justified mortgage loan interest rate against the prevailing cost of debt in the mortgage lending environment. This in turn allows prospective homebuyers to precisely gauge the level of underpricing or overpricing of homes in their community. Fourth, the finance-based methodology is a very accurate and very objective analytical methodology to utilize in order to analyze residential real estate property. Fifth, the finance-based methodology is a feasible valuation approach to evaluate new home purchase opportunities and existing home purchase opportunities. And six, the finance-based methodology only requires a minimal number of input variables to facilitate an analysis. With these points in mind, it is important for prospective homebuyers to remember that the finance-based methodology is a very difficult methodology to understand for people that do not have a financial education. Therefore, many people will likely need to spend a significant amount of time working through a finance-based analysis in order to completely understand how to apply the methodology and understand the implications of the analytical results that are derived by using the methodology. In addition, prospective homebuyers need to understand that the finance-based methodology is a relatively foreign process because it is not utilized by mainstream society in order to analyze residential real estate property. With these points in mind, prospective homebuyers need to remember that it is very difficult to apply the finance-based methodology without the use of the ARVA residential real estate analysis software application. Moving away from the finance-based methodology, let us now examine the expense-based methodology, which is the second methodology that was developed by Adkins Capital Management in order to help prospective homebuyers analyze residential real estate property. The expense-based methodology is a straightforward process that will allow prospective homebuyers to analyze the operating expenses that are associated with owning a home. These expenses include interest expense, maintenance costs, property taxes, natural disaster insurance, private mortgage insurance, real estate agent transaction costs, and closing costs. The expense-based methodology also allows the prospective homebuyer to take into account the benefits of the interest tax shield. By utilizing this information, the expense-based methodology will allow prospective homebuyers to evaluate total homeownership costs expressed as a percentage of household income, and it will allow them to determine the dollar amount and interest rate amount in which a home will need to appreciate in value each year in order to offset the costs associated with owning the home. Now that I have provided an overview of the expense-based methodology, let me provide 5 advantages that prospective homebuyers need to consider. First, the expense-based methodology is based on the correct premise that the price of a home should be a function of the ongoing operating expenses associated with owning the home. Again, this premise is very important for prospective homebuyers to understand, because in many cases, they incorrectly believe that the price of a home is simply a function of what it costs to produce the home, or is a function of what a comparable home recently sold for in the community. Second, the expense-based methodology is based on the correct concept that the price of a home should only require a modest appreciation in its value in order to offset the ongoing operating expenses associated with owning the home. Third, the expense-based methodology is a very accurate and very objective analytical methodology to utilize in order to analyze residential real estate property. Fourth, the expense-based methodology is a feasible valuation approach to evaluate new home purchase opportunities and existing home purchase opportunities. And fifth, the expense-based methodology facilitates the ability to accurately assess the 7 costs associated with owning a home. With these points in mind, it is important for prospective homebuyers to remember that the expense-based methodology is difficult to understand for people that do not have a financial education. Therefore, many people will likely need to spend a significant amount of time working through an expense-based analysis in order to completely understand how to apply the methodology and understand the implications of the analytical results that are derived by using the methodology. In addition, prospective homebuyers need to understand that the expense-based methodology is a relatively foreign process because it is not utilized by mainstream society. With these points in mind, prospective homebuyers need to remember that it is very difficult to apply the expense-based methodology without the use of the ARVA residential real estate analysis software application. In order to help solidify the analytical methodologies that I have explained up to this point, I am going to use the city of Detroit as a case study example. As you are probably aware, Detroit has experienced a dramatic decrease in its population over the last 50 years. The city's reduction in population from approximately 2 million people to approximately 700,000 people is primarily due to the restructuring of the big 3 automobile companies that are located in the metropolitan area and the negative impact that it has had on the ancillary companies that support these organizations in the surrounding area. As a result of the changes that have taken place, the number of high-paying jobs in the Detroit area has decreased dramatically, and the salary level of many of the jobs that have been retained has decreased substantially over time as well. As a result, the breadth and depth of the earnings power of the people that now live in the Detroit area can no longer support the number of homes or the price level of homes in the Detroit area. The implications of these changes are profound and illustrate the problems associated with using traditional residential real estate analysis valuation methodologies in order to analyze residential real estate property. For example, if you visit an internet website that lists homes for sale in the Detroit area, you will find literally thousands of homes for sale that have an asking price that is far below what it would cost to produce the homes. As of 2014, prospective home buyers could literally find a nice home to purchase for less than $50,000. With this in mind, it is evident that there are material problems associated with using the cost-based method to evaluate the price level or value of homes in a community. Moreover, from the standpoint of using sales-based data, it has been found that the historical home price levels in the Detroit area are not an accurate barometer of current home price levels. In addition, the current range of comparable home prices in the real estate market is too widely dispersed to provide an accurate benchmark proxy. Furthermore, the reasons in which people are buying homes in the Detroit area vary widely from prospective homeowner and investor. Therefore, as these problems illustrate, There are material problems associated with trying to use sales-based data to evaluate the price level or value of homes in a community. With these issues in mind, the housing environment in the Detroit area illustrates the problems associated with trying to use the traditional analytical methodologies for analyzing residential real estate property, and helps illustrate why residential real estate property should be evaluated primarily from a finance and expense-based perspective rather than from a cost or sales-based perspective. Now that I have provided an overview of the finance-based methodology and expense-based methodology, let us work through a comprehensive analysis in order to better understand how a prospective home buyer would use the ARVA residential real estate analysis software application in order to conduct a residential real estate analysis. To begin, assume that the prospective home buyer has an annual pre-tax household income amount of $40,000 and that he is considering the purchase of a home with an asking price of $130,000. Let us also assume that the prospective home buyer is not going to make a down payment when he purchases the home. In addition, let us assume that the median household income level in his community is $25,193 and that the median home price level in his community is $50,200. In order to conduct a finance-based analysis, the prospective home buyer will need to determine the prevailing mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan in his community. In this case, let us assume that it is 4%. The prospective homebuyer would also need to make an assumption about the percentage of pre-tax household income that he believes is the largest amount of money that should be spent in order to repay the principal and interest costs of a mortgage loan. In this example, let us assume that this amount is 28%. By providing this information, the ARVA Residential Real Estate Analysis software application can be used to conduct a comprehensive finance-based analysis. The next step in the analytical process would be to use the Adkins Residential Real Estate Analysis software application in order to analyze the 7 costs associated with owning a home by conducting an expense-based analysis. In most cases, these costs would need to be expressed as a percentage of the home purchase price. For this analysis, we assume that the cost of debt was 4%, that property taxes were 3.3%, that maintenance costs and natural disaster insurance were each 1%, that private mortgage insurance was 0.55%, that closing costs were $2,800, amortized on a straight-line basis over 7 years, which in turn represented an expense of 0.31%, and that the real estate brokerage commission would be 5%, which was amortized on a straight-line basis over a 7-year period as well. In order to complete the expense-based analysis, let us also assume that the prospective home buyer is in the 25% federal marginal income tax bracket, and that he is married and filing income taxes jointly, which means that the standard deduction amount of $12,400 would be taken into account when determining the potential net savings benefit of the interest tax shield. Once the analytical information has been entered into the ARVA Residential Real Estate Analysis software application, the prospective homebuyer simply has to run the analyzer in order to generate a comprehensive analysis. In this example, the ARVA Residential Real Estate Analysis software application determined that $195,497 is the largest amount of money that the prospective homebuyer should spend in order to purchase a home, and that the prospective homebuyer would need to earn $26,599 per year in order to be able to afford to purchase the home. In each case, the prospective homebuyer meets these criteria, as the sales price of the home is $130,000 and his household income amount is $40,000. From a finance-based perspective, The ARVA residential real estate analysis software application determined that homes in the community are underpriced because the justified mortgage loan interest rate was calculated to be 12%, meaning that the prevailing mortgage loan interest rate would have to increase from 4% to more than 12% before homes would be classified as overpriced in the community. This calculation is very important because the spread between 4% and 12% can be used to gauge the level of risk in the housing market. In addition, the justified percentage of household income amount was calculated to be 13.8%, meaning that prospective homebuyers could spend more than twice the percentage of pre-tax household income that they are currently spending before homes would be classified as overpriced in the community. This calculation is also very important because the spread between 13.8% and 28% can be used to gauge the prospective homebuyer's risk profile in terms of the home price level in the community. Given this information, the prospective homebuyer should reach the conclusion that homes are significantly underpriced in the community, given the earnings power of the people that live in the community, the prevailing cost of debt in the mortgage lending environment, the risk in the housing market, and the prospective homebuyer's risk profile. Now that we have determined that homes are significantly underpriced in the community, the prospective homebuyer should use the results of the expense-based analysis in order to determine if buying the home would be a prudent financial decision. In this example, the ARVA residential real estate analysis software application determined that cumulative home ownership costs over a 30-year time horizon would be $271,178. This is a hefty sum to pay over a 30-year period, considering that the purchase price of the home was $130,000. Given this expenditure level, the prospective homebuyer would likely reach the conclusion that he should not purchase the home. In order to help put the operating expenses associated with owning the home into proper perspective, it is important to note that the cumulative annual home ownership costs would be $12,600 in the first year after the home is purchased and would only trend down to $8,800 after living in the home for 15 years. This, in turn, would require the home to appreciate in value from 10.1% in the first year after the home is purchased to 7% after the home has been owned for 15 years. Therefore, given the high required home appreciation rate, the prospective homebuyer would likely reach the conclusion that he should not purchase the home. On a positive note, the home purchase opportunity is an affordable endeavor because it would only require 31.6% of pre-tax household income to be spent in the first year after the home is purchased, and this amount would trend down to 21.9% after the prospective homebuyer lived in the home for 15 years. Therefore, if the prospective homebuyer is extremely interested in purchasing the home, there are a host of strategies that he could utilize in order to reduce the expenses associated with owning the home to a level that would make purchasing the home a prudent home purchase decision. For example, the prospective homebuyer could reduce his operating expenses by making a significant down payment amount in order to reduce the interest expense on his mortgage loan. He can make a down payment amount of at least 20% of the home purchase price in order to eliminate the need to carry private mortgage insurance. He could negotiate with the mortgage lender in order to obtain a lower mortgage loan interest rate. He could negotiate with various parties in order to reduce the closing costs associated with purchasing the home. Or he could handle the real estate transaction on his own in order to eliminate the commission expense that is typically paid to a real estate agent. By utilizing one or more of these strategies, the prospective homebuyer could reduce his ongoing operating expenses to a level where he would be making a prudent home purchase decision. Now that I have provided an overview of the two traditional methodologies that are used to analyze residential real estate, and two methodologies that have been developed by Adkins Capital Management, which can be used to help prospective homebuyers make a prudent home purchase decision, I believe that it is important to highlight 5 key points that prospective homebuyers should remember when considering the purchase of a home. First, the exclusive reliance on the cost-based methodology or sales-based methodology will likely cause prospective homebuyers to make an imprudent home purchase decision, because these methodologies have a host of significant shortcomings that are pertinent to conducting a comprehensive residential real estate analysis. Second, prospective homebuyers should not rely on the financial advice provided by housing industry associations, home builders, real estate agents, or mortgage lenders, because these groups of people have a biased financial interest for promoting home ownership and in trying to sell homes for as high of a price as possible. Third, prospective homebuyers should not rely on the residential housing information provided by the financial news media, because much of the financial news media's financial sponsorship comes from individuals and groups that benefit financially from housing activity. Many of the news media's recurring guests benefit from increased housing activity, and in most cases, the news media does not provide a counter voice that expresses the best course of action that should be undertaken by prospective homebuyers. Fourth, prospective homebuyers should not rely on the residential housing guidance provided by governmental agencies such as Fannie Mae or Freddie Mac, because these entities are directed by political officials to put in place housing policies that have a secondary agenda, such as promoting home ownership in order to bolster economic activity, or promoting home ownership in order to increase job activity. Unfortunately, in many cases, such policies are not in the prospective homebuyer's best financial interests, and ironically run contrary to prudent long-term public policy. Fifth, prospective homebuyers should remember that elected officials typically support policies that promote home ownership, because it gives the appearance that they are doing something constructive from the standpoint of helping their constituents achieve the American dream. This, in turn, helps the elected officials garner higher approval ratings and voter support during elections. Unfortunately, in many cases, the housing policies that elected officials support are not typically in the prospective homebuyer's best financial interests and run contrary to prudent long-term public policy. Now that I have provided a comprehensive overview of the types of residential real estate analysis analytical methodologies that prospective homebuyers can use to analyze residential real estate property, and the issues that prospective homebuyers should be considering before purchasing a home, I believe that it is important to highlight 4 key reasons why prospective homebuyers need to be using the ARVA Residential Real Estate Analysis software application. First, the price of a home that is purchased with debt is a function of the income level that will be used to repay the debt, the percentage of the income level that will be used to repay the debt, and the cost of debt. Therefore, prospective homebuyers need to use the ARVA Residential Real Estate Analysis software application in order to have the ability to generate a finance-based analysis. Second, the price of a home should only require a modest appreciation in its value in order to offset the ongoing operating expenses associated with owning the home. Therefore, prospective homebuyers need to use the ARVA Residential Real Estate Analysis software application in order to have the ability to generate an expense-based analysis. Third, prospective homebuyers cannot build a proprietary analytical spreadsheet or subscribe to use a residential real estate analysis software application that has the capabilities of conducting a finance-based analysis or expense-based analysis for less money than it would cost them to subscribe to use the ARVA residential real estate analysis software application. And fourth, buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home. Therefore, prospective homebuyers need to use the ARVA residential real estate analysis software application in order to be able to make a prudent home purchase decision. In closing, I hope that this presentation provides a thorough understanding of the issues that prospective homebuyers should be considering before they purchase a home, and I hope that this presentation helps convey the valuable information and analytical tools that are provided by Adkins Capital Management. With these issues in mind, I would like to remind you that you can subscribe to use the ARVA Residential Real Estate Analysis software application at any time and from anywhere. For more information, please watch the video titled Adkins Residential Home Valuation Analyzer. Thank you for taking the time to listen to this presentation.